Property data. It's one of those things. Everyone talks about it. Everyone says data this, data that. What the hell does it all mean? This session is exactly about unpacking and understanding property data that's real. What is the stuff that actually matters? What are some of the myths that are out there that exist about property data? And how can we go out there and use this complicated fugazi and put it into terms that simply we can understand, so that we can go out there and actually buy investment properties that are going to grow. We don't want to be buying in a market that has already seen an amazing amount of growth, because it may not lead to the future capital growth. How do we identify those markets? So in this live session, we have Matt from HTAG along with Jeff Miles, and we are going to go through looking back at history. Okay, well, you've got this great thesis about data. Let's go back in time and use that thesis against markets that have grown to see if we can actually reverse engineer it. So we go and look at markets that have potential right now, and then we go back in time and look at property markets that have already done well, and see what the correlation is between the two of those. So this is an unreal session. You're going to get a whole heap of value. If you're a brand new investor and trying to understand data, you're going to love it. If you're a more advanced set data person, we do dive deep into that stuff as well. So there's heaps of value there. Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we created Oz Property Investors, Australia's largest property investor community. We have over 78,000 property investors in it. It's amazing. It's there to help you all grow as investors, become better property investors, so that we can all learn and grow together. We give this stuff out for free, so that you can go out there and make better, more informed decisions. And each week we interview top property experts, exactly like Matt. This is going to be worthwhile watching. You need to save this one. You can't put this one on 2x speed. This guy's fast. He's quick. He gets to the point, and there's a lot of value in there. So let's jump in. The one data metric that people focus on, and how bad that, how bad that is. One of these ones that I keep hearing is the property market must not have grown it has to have grown less than 50% in the last 3 years. Once it hits that 50% mark, we don't buy there. That's the rule. 50%, it's gone in 3 years. We're stopping, or we're all out. We're all done. What are your thoughts on that?
Yeah, I hear that as well. And I think I can talk about this for hours, but let's distill it first. So first, I think it's very dangerous to, and we said this at the beginning, I think it's very dangerous to reach a conclusion about an area from a particular metric. Another thing that I would like to say, growth patterns across different timeframes are just an indicator, but they don't actually lead to growth itself. So if you're analyzing an area, you need to understand that everything functions on economics. And what are economics? Supply and demand dynamics. So the fact that an area, for example, has grown 50% in the last 5 years, the area might still have reducing supply and increasing demand, which means it will grow more. So this making a decision purely on the growth patterns without actually analyzing the supply and demand dynamics is inappropriate, because you're completely, essentially walking blind into a decision.
Yeah. It's not.
Sorry. So I'm not saying that those kind of. I'm saying actually I'm in favor of trying to analyze as many data points as you can, and I sometimes even get overwhelmed. I actually sat down today and I did a report for a client. I analyzed 40 suburbs across 80 metrics. Okay, so, and it is a very onerous process. Now, I'm in favor of actually layering and putting additional information so I can actually triangulate and make a better decision. But, you have to understand how growth works. It works from simple economics, and making a decision purely on growth patterns. Growth patterns are just an indication of a cycle. But that cycle could continue, could dampen, and then the question of time frame. Let's say an area has grown 50% in the last 5 years. Well, it might have another 20 or 30 in the next 2. So if your investment time horizon is short term, i.e. you buy and flip or you develop, well, that area could be a potential, investment opportunity. Now, going back to the strategy and the brief, it all depends why you want to participate in the market. So saying that we shouldn't invest in an area that has grown 50% at all, it's just, it doesn't consider the individual circumstances and also the supply and demand dynamics that actually lead to growth.
Yeah,
you might have different time frames. You might have different time frames. You know what I mean?
Yeah, I was looking on the platform, trying to kind of find and illustrate this point a little bit more. And this is a suburb here that at the 3 year. So if you look at the 1 year, this property did 46%. And if you bought this, if you're like, oh well, oh my gosh, it's run out of steam, you would have missed out on when this property hit. Over 3 years, it's done 107, right? So for me, right now, no, do not buy in this market because 107, and obviously you have to look at the rest of the data, is pretty aggressive. You're going to have to look at the affordability. Can these people that live here from 2023, the price is down here, it's now up to the 800, so 500 to 800. That's massive. But if you cut out at 50%, you would then have 57.4% that you have missed out on because of that one metric alone.
Correct. Correct. And you said the right thing. I mean, it's very important to determine the steam of the market. And the steam of the market, again, relates back to how long do you want to participate in the market. And in order to determine the steam, let's say you want to participate 4 years, you need to figure out, okay, is there 4 years of steam left in this market? And you said one thing, you would layer affordability, you would layer supply and demand dynamics, metrics, and then furthermore, hold periods, these other risk factors such as renter to owner ratio, etc., just to see if there's actually more steam in the market. And again, as I said before, the question is not about that market in isolation, but let's look at other markets if they give us a better opportunity as well in comparison to that one. But simply making a decision or a call on growth patterns, as you rightly pointed out, if you had the 50% rule, you wouldn't have invested after the first year and would have missed the 60% growth.
Yeah.
How do you link that sort of data? So what are the key things that go into the data side versus the strategy? And because that, if you make a mistake, as Joe said, that can really set you back. So what are the sort of key things one of them is risk tolerance, but the other things, what are those couple of
things? So first you have to know the budget. And I mean, budget is very important because budget allows you, gives you information on what you can actually get. This is why I'm actually averse to the notion of hotspotting because a hotspot for me is not a hotspot for you, simply because if you have different budgets, what good is it for me to invest in the 800K area when I have only 500K to spend? So, and when you have a particular budget, there's an economic underpinning to that budget as well, which allows you to extract certain average from the market. I mean, I speak to investors on day-to-day basis, and sometimes they come to me and say, Matt, I want to invest in a 350K market, but I want 8% average growth for a decade. That's not going to happen. So it's just because the economic underpinning of that area is insufficient enough to generate that growth. If it was, it wouldn't be 350, it would be at 800K. Now, don't get me wrong, the area will still grow, but I'm talking about 2 or 3 or 5% above average, which is 5 in Australia, and you're expecting that to happen for a decade or 15 or 20 years. So you have to give some leeway. Understand that budget provides boundaries from what you can achieve, Now you can. Lower budgets means lower risk, in a sense. Lower risk is in lower financial outlay. But you have to understand that, sometimes you can't get 8% yield and 15% growth annually. Then the next thing that I always ask for is the investment time horizon. That sort of relates to what Joe and I were discussing, what I was saying to Joe. Depending how long you're in the market will dictate, what metrics are important and what areas you can pick. I mean, investing at the top, at the peak of a hotspot is all good and well for those who are renovating because they're going to hold on to an asset from 12 weeks to 6 months. So they don't care. I mean, they want to leverage the market momentum and dispose of that asset right away. So the fact that it's at the peak of the hotspot is actually a preference, But if you're in the market, let's say for 5 years, that means that you want to leverage the full extent of a hotspot. Hotspot lasts anywhere between 1 to 4 years, which means you want to enter a little bit before, leverage the full cycle of a hotspot, and then exit. But if you're 15 or 20 years, then again, the approach to the market varies. You don't care how much you, make instantaneously. You approach data in a different way. So it just all depends on time frame. I need to know that. The third thing that I need to know is when do you want to extract equity into a subsequent purchase? And this is where it comes to gray zones between cold spots and warm spots, between warm spots and hot spots. What I mean by gray zones is you get clients who don't want to enter a hot spot because there are negative hallmarks associated with it, such as the inability to actually find appropriate real estate, the ability to find real estate that's priced accordingly, and you're fighting or elbowing your way through with 10 or 15 buyers agents fighting for the same property, even 30 in some instances. So if you want to extract the equity, this is what I need to know. So sometimes clients come to me and say, listen, man, I don't want to enter a hotspot, but I do want to extract equity in the next 3 years, or have the ability to extract equity in the next 3 years, which means that we need to align the data in such a way to position the client to enter a market which will become a hotspot in the next 2 to 3 years. So usually a warm spot generates anywhere between 0 to 5% growth, and a hotspot is 10% plus. So when you compound all of that, you might be looking at 30, 40, 50% growth in those 3 years, and then the client can extract, So the timing matters. The timing when it comes to extraction of equities are also very important. And then finally, as we said, it's the risk profile. And risk profile essentially relates to timeline. If your timeline is very short, you can be very, very relaxed with risk. So essentially, the question 4 is essentially a bit redundant because it relates to question 2. What is your investment time horizon? So if your investment time horizon is short, you can invest in a centralized mining town. Now, you have to hope and pray a little that, the mining town is not going to be affected in the next year, but usually it's not. Usually you can see the macroeconomic changes happening. If the interest rates are going down, we don't have issues with China or whatever, you might not see an impact within that year. So you can invest in those rampant hotspots such as Rockingham or Gladstone or whatever it is, that have high long-term risk, but because you're in it for short-term, you don't care. You get in and you get out. So that's what I need to know in order to lay out metrics.
What's your view of property investing over the next 3 years? Like, we've had a massive growth cycle. Some markets, as I just showed, have grown 107%. Like, what the hell is going on? Are you bullish? Are you scared shitless? Like, how do you think about property investing for the next 3 years?
Oh, that's a deep question. I'm bullish. I mean, I'm bullish simply because, again, everything moves through cycles. And while one area grows, the other one stagnates, and we've seen that from the WA Victoria dichotomy. So you can take advantage of counter-cyclical investing always. I do think that we're sort of at the precipice of another interest rate reduction, whether it's now, next year, in 2 years, but essentially the debt cycle is essentially changing. So they're going to start printing money, which is allow for, I guess it's going to be cheaper to buy property, which should, inform market growth. I do think that population is growing in Australia as well. Obviously, higher population levels, bigger demand. Now we do have an issue with the aging population. So that might affect patterns of downsizing, etc. But overall, I think because Australia is importing people, essentially, population is coming from externally. I don't think we're going to have an issue with the aging population and the fact that interest rates are going to go down. I think we will go through another round of growth. Now, it all depends where. I don't think that every area will grow equally. Some will grow more, some will grow less, some will not grow, but yeah.
Yeah, it's interesting because I think that 2-3 years ago, you could throw a dart at the map on Australia and get whatever the hell you wanted, and it would work absolutely fine. My belief is those days are gone. That it's not that easy anymore. The government printed billions and billions of dollars. You could just go to WA, throw a dart. You could go to South Australia, throw a dart. Queensland, throw a dart. Victoria, don't throw that dart.
That's exactly. It's a perfect example, and the reason why you could throw a dart, and a lot of businesses, and good on them, have built a substantial financial base from that period. I think good businesses and good buyers agents or good investors are seen when the hard times are hard, not when they're good and easy. So, government is not going to print as much money as it did before during COVID. I don't think it will happen. However, the interest rates will come down. So, and as you said,
doesn't mean they're going to print money.
No, it's going to become easier to borrow. But however, they're still printing, by the way. They're printing all the time, not to that extent, which is why I'm saying the shopping cart analogy. This is happening because of debasement of currency, because they're printing constantly and the dollar actually has less value, intrinsic value. So they are printing constantly and the interest rates will go down. Now, there are two opposing things, and we don't want to get into economics now, but it's going to become easier to borrow and purchase essentially. But yeah, during COVID, it was, you had handouts everywhere, people were making money and good on them, you know what I mean? And even at that time, some areas weren't growing, as you rightly pointed out. So some were pumping, some weren't that much,
want to know, Ricky has asked an answer. He said, what are the 5, and this could do a whole session on this. What are the 5 most important or most interesting if somebody's just landed on planet Earth from wherever they've landed from, Mars or whichever planet, and they ask you, Matty, what 5 data points not the free boom, the 5 boom data points we should be looking at, or the more important things if you don't know anything to start off.
You can only go. You're stuck on an island. You need to work out the price of property. Here's 5 data points. Which ones are you taking with you?
Yeah. See, I'm a bit, what's the word that I like and don't like those questions, and I'll tell you why. Like, I answer them straight, so I don't want to, weave around it. Essentially,
sounds like you're weaving.
Essentially, it's supply and demand. You need to establish a scarce supply, and you need to understand that demand is increasing. And what are the data points? Stock on market, inventory, building approvals, hold periods, days on market, vacancy rates. Is that 5 or 6? That's 6.
Yep. So hold periods, I think, is probably the least like that's an important one, but you're not like buying specifically based on that. So I had to include the hold periods, and I'll tell you why. Because if I give you all of those other ones, you have only short to midterm understanding. But if you include the hold periods, you're going to have a longer term understanding of the area. So this is the standard suburb page. The top you have the typical value, yields, information. I think everything has a narrative around it, so people need to understand what the metrics mean, etc. You have the RCS scores here, which is our algorithm for projection. It's a 5-year plus metric, and it says it has a very low risk, this area, i.e. it has a diversified industry and lack of exposure to negative environmental effects. Its capital growth score is 48. Let's say average is 50, I would say. Cash flow score is a bit better. It's 57. So I would say, just looking at the RCS, I would say that it's more, it's a stable area, and it will be better positioned for long-term buy and hold, as opposed to, now I have to look at the supply and demand dynamics, as opposed to like those quick kind of a substantial returns. You can expand. We have an AI narrative about this area, but I'm not going to go into it. I'm going to actually explain the metrics, which is much better than this AI narrative. So what do we have? Diversification index is 80 out of 100. As you can see, it's green. It's positive or opportunistic. Lack of no exposure. So economic diversity index is I'll read it out. So it's an index that highlights the level of diversification of industry in a particular suburb. So the higher the index, the higher the value there, the more diversified the economy.
And what's a good, I mean, I see that's in green for those listening along, and it's at an 80. So where does it sort of start to look particularly juicy? Like what range?
Yeah, so we have a data dictionary on our page which provides you with ranges. I think from memory around 70. 70 would be orange, so that would be sort of neutral. I think you start going into red, 50 and below. But I think above 70 would be green. From memory, don't quote me. I'll have to refer back to the ranges.
Yeah. Okay. Yeah. So no bushfire risk, no flood risk whatsoever.
No bushfire, no flood risk. School rank, so it's 58. It's from a score to 100. So it's essentially a school rank public schooling system, which is pulled from NAPLAN and ACARA databases. It's from 100. Now, it's very rare to see a public schooling system at 100. I think the highest we see in the 70s mark. So it's not too bad. It's neutral. We see, and this is important for owner-occupier demand, by the way, but I mean, in the hierarchy of significance, out of 10, it will potentially be a 6. And when I say in the hierarchy of significance, I refer to that in terms of correlation to growth. We have infrastructure spending, but this is per capita. So it's 2,743, which is extremely elevated, which is phenomenal. It's great. So that means that there's a lot of building going on. Again, it's a positive. And when I analyze suburb pages, when I go through it, just imagine you're going through and you're giving a tick or a cross at every metric. At the moment, we don't have a cross, essentially, because all of them are positive. But this one, we deserve a double tick, essentially, because they're obviously building and spending a lot on infrastructure in the suburb. Now, a little, I guess...
overall, or like how do you determine
these suburbs specifically?
Well, what are they doing in that suburb specifically? Because
so I have to pull from the data set to see but it's essentially pulled from ABS and different other sources. We have a data set in the background, so I can post all the projects that I'm doing, but it's essentially non-residential building approvals such as education, healthcare, aged care, transport, and other buildings.
Right. Are you just reading from the list? Yeah. Okay. Cool. So that's Matt. So 2,700 per capita, and this is what you talk about doing it for a ratio, because then it doesn't matter how many people. If there's 100,000 people and they're spending, $1 million, that's not really as good as if there's 50 people and they're spending $1 million, right?
Absolutely.
Nice. Okay. Double tick. So far, so good.
And the last sentence there is also very important. And this is how you start creating narratives and connecting metrics. See, the last sentence says, this metric serves as a proxy indicator of infrastructure investment in any given area. Now, it's also a good precursor to population growth. However, this needs to be combined with another metrics to establish a good precursor to population growth. It needs to be established with this. So if you have a very diversified industry, and it's not reliant on a single mining town, this means that these non-residential building approvals are not going towards supplementing for the project itself and around it when the government builds to actually enable the functioning of the project, but it's actually going towards building roads, bridges, and hospitals in a particular suburb, which are accommodating for population growth.
Yeah, right. Rather than shorter term, like somebody could be supplying
in a single mining town, you have a lot of infrastructure projects, but they most of the times are going primarily towards the operation of that project itself. Now, what I mean by operation, it will be roads, bridges, and all the other things that are accommodating for the project itself as opposed to population growth.
Yeah.